CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Well, as we bid goodbye to 2023 in a few days from now, it's time for our special offering, the big winners of 2023. We'll be focusing on stocks which have really shown a very stellar show in this year. Today, we're focusing on Birla Corp. The stock is up more than 40% in 2023. Mr. Sandip Ghose, the Managing Director as well as the Chief Executive Officer, joins us on the show. Hi, good morning, Sandip. Thanks so much for joining in, and congratulations. Your shareholders are very, very happy. You know, at the start of this year, you had valuation comfort. Now, that seems to have trimmed down a little bit because now the stock trades at more than $90 per ton on an EV per ton basis. So the outlook is going to be important. Tell us a couple of numbers. One is on the volume parameter. You all were guiding for around a 15% growth in terms of volumes for the year. Do you maintain that? And also for the year, the EBITDA per ton, you all were talking about 850 rupees per ton. That would mean the second half of the year has to be far better. Do you stick to both these two numbers?
Volume we definitely stick to. I don't see any reason for volume being, under pressure or threat, because our volumes are based on, both the market projection as well as our own internal, some of the capacity additions which had come up and the scaling up which is happening especially in our down south in the Mukutban plant in the central Vidarbha region. Well, that's so I think volume we are very comfortable. EBITDA we indicated about 850, closer to 850, and we have so far the assumptions on which it was based. We don't have any reasons to revise it. We'll take a closer look towards the end of the year, but so far I think all the indications, both for us and the industry, I think are moving in the right direction. Everybody, I think, has based things on a fairly conservative plane this year, especially on the prices front. And so there, I think that's why we are sticking to our projections, because we don't see a major disruption in the market.
Okay, the reason I ask you is because second half of the year, you'll have to do nearly 1,000 rupees per ton to get that average to around 850 rupees. For the time being, you're appearing fairly confident. I wanted to ask you about, since you have your core focus would be on states like MP as well as UP, and MP went for an election. So was there any slowdown in terms of demand? Did you experience that? And also since, I've been tracking the cement space for a while, Central India is getting very, very competitive. Do you believe so as well?
See, yeah, it is getting competitive. There is a pressure on capacity utilization of most players, but there, I think we are reasonably more comfortably placed, without getting complacent about it, is because our factories have been running in Central India at 95% plus capacity utilization. And we are therefore not really in a volume game. We are focused, in our chosen segment and the geography where we expect to retain our market share, both in value terms as well as in volume terms. Why I say value terms is, we are a very uniquely placed company where we have got almost 50% of our volume coming from the premium end, another 50% coming from the value end, which is very distinct from other cement makers who are present by and large either only on the premium end or on the value end. So they face the competition in each segment, in isolation. Whereas we are able to straddle between the two segments, and with a relatively, robust but smaller market share, we are about 20% in our core markets in those areas. And with a strong brand equity, plus I would say very strong go-to-market assets in terms of sales and distribution, in terms of our people, logistics capabilities. So that's where we expect to hold on to our own.
So, Mr. Ghose, you said volume guidance 15% for FY24. Can you also help us with some numbers on the EBITDA front? Earlier, you had guided for an EBITDA per ton of 850 rupees. So, do you think you can maintain that for a full year of FY24? Or given the kind of pressure, perhaps there could be some dip there as well. And if you can give us an early indication of what FY25 could look like in terms of an EBITDA per ton?
I wouldn't go into FY25 just now. FY24, I just mentioned to your on the show earlier, that we are staying by our indication of closer to 850. We don't have reasons to change it just now because there are certain upsides and tailwinds which we have assumed in and which so far seem to be on track.
Can you also give us some indication of what debt would look like? There is 1,000 crore capex that you have in this year. So the concern is that the debt may not come down. What is the expectation of net debt by the end of... Yeah, go ahead.
We're not expecting debt figures to change just now. That's why we are not going in for any major capex expansion. Our current, priorities is scaling up to Mukutban, which is our new facility, which was earlier delayed due to COVID and various other factors. It's ramping up. But right now, we are tracking very much as per our expectation and what we have projected. We are very happy with the scale up which is happening there. So by the end of the year, that will put us on a firm footing. Meanwhile, we'll obviously not compromise on our sustenance capex. And then going forward next year, we've already announced our first new grinding unit in UP. We'll go for that.
Okay, all right. But debt will not come down from these levels?
At this moment, we are not looking at debt coming down significantly.
Got it. Final question then. What about inorganic growth? At Kesharam Industries that went into the Ultratech fold, did you all have a look at that asset? And I can see a smile on your face. So I want to know your plans in inorganic growth. You're already at around 20 million tons. As you said, you'll have laid out a couple of grinding units as well as some clinker. Where do you see you headed to? And also, if you have to go for inorganic growth, what is the ticket size you look at?
We are not looking specifically at inorganic growth. We have been very, very, I think, transparent in our, statement of our intent. Our objective is to get from 20 million ton to 25 million ton in 26, 27. And at the moment, we see that happening primarily from organic growth. And that path has been laid out. We are going to, our next big ticket expenditure would be line 2 in Maihar, which is the Reliance unit which we had acquired. It is all laid out for the second line expansion, and that's what we are going to do, almost equal size. Prior to that, we put some grinding facilities in place, and the first step towards that is UP, which we just mentioned. So at the moment, we are not, unless something comes very attractive, we are not looking at anything inorganic aggressively.
Okay, all right. We'll leave it there, sir. Thank you very much for joining us, and it's a pleasure getting those details from you, for our viewers. Thank you very much indeed.